And welcome to Inside India. I'm JP Ong, and here are your headlines. President Trump is taking aim at friend and foe at the UN, singling out India and China once more for buying Russian oil, saying they are funding the Ukraine war. The U.S. updating its H-1B visa approval process that would give more weight to higher skilled and higher paid workers. We'll discuss how this could be a boon to India's global capability centers. And markets are mixed as Fed Chair Jerome Powell says equity valuations have gotten lofty, as he also strikes a cautious note about the Fed's next move.
The overall economic effects of the significant changes in trade, immigration, fiscal, and regulatory policy remain to be seen. Tariff increases will likely take some time to work their way through supply chains.
Good morning, and ahead of the Wednesday midweek session, we take a look again at what Asian markets are doing today. And you heard it from Jerome Powell of the Federal Reserve saying that equity valuations might be a bit lofty right now, and thus also keeping a lot of traders and investors in this part of the world on the back foot. The Nikkei 225 trading about 0.4% in the red, while we're also seeing markets like the South Korean Kospi down by more than 1%. One notable standout, actually, that's withstanding the storm is the Hang Seng Index, which is holding on to gains of about 0.6%. This with the tech index, they're getting a boost from Alibaba's launch of its latest large language models, actually, and thus also keeping tech shares in Hong Kong actually upright, despite the fact that Hong Kong itself is dealing with a massive typhoon that's currently hitting and testing the city as we speak. Indian markets are also set to come online in about 45 minutes. And here's what Gift Nifty futures are indicating with regards to where the stocks in Mumbai might head. And we keep in mind that they are on 3 straight days of losses right now, and actually did pull back a little bit once again at the end of the Tuesday session. We're seeing that Nifty futures are foreshadowing just a very slight gain, perhaps flat to the upside right now as compared to Tuesday's close. 25,181 is where those Nifty futures are pointing. Meanwhile, the Indian rupee continues to trade at a new record low, actually, or weakest on record, 88.84, and it's dangerously coming close or flirting with possibly testing that 89 to the US dollar level. And at the United Nations General Assembly, in his address, President Donald Trump of the United States took aim at countries that he believes are still supporting the Russian war economy. And this is through purchasing Russia's energy products. Among those countries included India.
And India are the primary funders of the ongoing war by continuing to purchase Russian oil. But inexcusably, even NATO countries have not cut off much Russian energy and Russian energy products, which, as you know, I found out about 2 weeks ago, and I wasn't happy. Think of it. They're funding the war against themselves. In the event that Russia is not ready to make a deal to end the war, then the United States is fully prepared to impose a very strong round of powerful tariffs, which would stop the bloodshed, I believe, very quickly. But for those tariffs to be effective, European nations, all of you are gathered here right now, would have to join us in adopting the exact same measures.
Wall Street closed lower after some comments from Fed Chair Jerome Powell suggesting that the expected further rate cuts for the rest of 2025 were not a totally done deal. U.S. Treasury yields also slid lower overnight, with CNBC's Eamon Javers telling us more about Powell's own comments.
Federal Reserve Chairman Jerome Powell speaking in Rhode Island on Tuesday and suggesting that the Fed faces significant challenges as it tries to weed its way through this market. Nothing of what he suggested today struck analysts as particularly new, but he did give his view of the labor market and what he called a low-fire, low-hire economy. Here's how he explained it.
We all see the data that it's just gotten tough for people just entering the labor force to be hired. But remember, the overall national aggregate hiring rate is at very, very low level. The layoff rate is also at a very, very low level. You're in a low-fire, low-hire economy, and it feels like companies are they've kind of stopped hiring or slowed down their hiring because they want to see how this all shakes out.
And the Fed chairman also addressed, although obliquely, the political pressure that he's been under from President Donald Trump, who has accused him of being too late and too hesitant to lower interest rates. Powell not referring to Trump specifically by name, but suggesting that people who are in positions like his are under a lot of pressure. Here's how he explained that situation.
Often things are seen through a lens of, is it good for this party or bad for this party or this politician? We're just not looking at things that way. We're looking at what's the best thing for the people that we serve in the medium term. What's the best policy? And many people don't believe us because they think, come on, you're really political. But the truth is, mostly people who are calling us political, it's just a cheap shot.
So Powell using the phrase cheap shot there, not saying that President Trump is guilty of a cheap shot, but of course President Trump is the leading figure who's been calling Powell political. Meanwhile, Treasury Secretary Scott Bessent says he's continuing to interview potential successors for Jay Powell's job, saying he's got 11 candidates in mind, and by the end of next week, he will have interviewed 10 of them. For CNBC Business News, I'm Eamon Javers in Washington.
Meanwhile, James Bullard, a rumored successor to Powell at the helm of the Fed, gave his own assessment of why the Fed's cautious approach to cutting rates might be the more prudent path.
I've heard the president say that he would, if inflation is a problem, just raise interest rates again. But if you have a whipsaw kind of policy, then markets start to worry about that. They start to price in inflation risk premium at the longer end. And that's very hard to get rid of. So it's a careful game that you have to play, and you have to be systematic in policy and clear as we can be about policy, and make sure that everyone's on board with the idea that we're going to keep inflation low and stable over the medium and longer run.
Stephen Myron, the most recent Fed appointee who just took the position last week and voted at the FOMC meeting, was speaking yesterday at the New York Economic Club and said that he plans to dissent with every one of the votes that continue to come up. I guess that's based on the assumption that the Fed is not going to cut rates as quickly as he or the president would like. Do you think that's the right move? Is the Fed moving in the right direction as far as you're concerned?
Well, he made a good speech yesterday, and he certainly makes interesting arguments about a lower neutral rate. And you could certainly vote as he wishes on the committee and make his case. He's a good economist, so a lot of good arguments in there. I think the committee thinks that the neutral rate is, for the federal funds rate, is about 3 or 3.25, somewhere in there. He thinks it's maybe 100 basis points lower than that. That would give the committee more room to maneuver. There's no doubt about it. There's a big confidence bound around the neutral rate. I guess one question I would have for what he said was, if we're as restrictive as what he's saying, why hasn't inflation come down more sharply and more quickly? That's one thing I would have an eye on about with respect to that argument. And also, I think the president's policies and the Republican policies here, I think, are ultimately going to be successful. I think there's going to be a reacceleration in growth, maybe starting now, but certainly in 2026. And so you have to be looking ahead and seeing that reacceleration coming. Usually that adds a little bit to inflation pressure, and so you got to take that into account. If you felt like there was recession was just around the corner, then maybe you go down very quickly, but that doesn't seem to be what Wall Street is thinking, and it's not what I'm thinking about what's going to happen in the economy over the next year or so.
And the OECD has lifted its projection for India's 2025 growth to 6.7%. That's a lift of 40 basis points from its last call. The OECD is pointing to monetary and fiscal easing and reforms to GST as reasons behind the projection raise. Separately, ratings agency S&P Global has maintained its call of 6.5% growth for this current year. Now, that's all in rosy, but will this actually translate into market action, and market positivity for India? Anand Gupta is the lead portfolio manager at Allianz Global Investors, and she's here to help us answer that very question itself. Anand, thank you so much for joining us today. Now, granted, in the second half of this year, the Nifty is still in the red, but we've seen quite a solid September rally for them based on a lot of these new changes and these developments with regards to the market. Are you still quite bullish, actually, on the prospects for the Nifty 50 and the Indian economy based on all of these new developments, and with some of them actually being quite positive, actually, admittedly?
Thanks for having me on the show. Yes, we have a very constructive stance on Indian equities. Indian equities have delivered more than 10% earnings CAGR for last 10 years, more than 6% GDP for last 10 years. We think that will continue. In fact, that will accelerate. What has happened is there was some risk management measures by Indian policymaker last year, second half. They tightened liquidity, they increased risk weights and various other measures. All of them have been reversed starting beginning of this year. And on top of that, we have seen consumption stimulus in form of income tax cut, GST rate cuts, and various other small reforms, which in aggregate means a lot. So we're quite confident that we are on a verge of re-acceleration of earnings. Stock market eventually follows earnings. So what got decelerated in terms of earnings momentum, we think we are already seeing a signs with inflation normalizing of re-acceleration. So very confident that next 2 quarters you'll see re-acceleration, and FY27, the next financial year, will be significantly higher than the current financial year in terms of earnings, and that will follow through into the stock market returns.
Yeah, Alan, one of your peers in the markets, actually, we spoke to a week ago, said that one of the reasons they're positive in India, actually, is because unlike other markets, the earnings transmission of positive macro developments tends to be faster towards corporates in India. Do you share that sort of sentiment? And if so, how quickly do you see some of these macro developments like GST reforms, upgrades in terms of GDP growth? How long does it take to manifest into earnings, the transmission mechanism, if I can call it that?
It's generally 6 months. If you see, GDP has already been upgraded by most of the sell-side estimates with the latest GDP print for the quarter which surprised everyone on the upside. S&P has upgraded credit rating. You just mentioned OECD has lifted GDP estimates. That shows you that the rate transmission, the reforms are already kicking into GDP. For the corporate earnings, there are some optics. When the rate transmission happens, the large banks, they have first a negative impact for first 2 quarters, because when they pass rates, their NIMs compress, their earnings compress. But it's just a lag of 2 quarters, 6 months. After that, it adjusts. So this second quarter, which will get reported September quarter, will be almost the last quarter when the private sector banks will have a NIM, net interest margin compression, and from there on it will start normalizing. So those are the optics. So whereas you're seeing it in GDP already, the reason you're not seeing very vividly in corporate earnings is, one, due to this bank NIM compression. 2, unfortunately, India had some external black swan events. It had an India-Pakistan conflict which went to a war, etc. So those things have also delayed the transmission. Otherwise, you would have seen consumption already reviving. But now, with GST reforms, since 22nd September, big cars are cheaper by 6%. They themselves bring a lot of conversion. Generally, conversion is 10% of footfalls into these stores for auto volume. Even that going to 12% means 20% higher sales. So we're very confident on channel checks, rural economy already recovering. We're seeing tractor sales, many other data points. So looks like the setup is good. And next 2 quarters, you will see vividly all the benefits of the efforts which have been done, just the way you're starting seeing in GDP.
So you've mentioned the banks and NIM compressions perhaps starting to ease, which will pave the way for them, and also auto is actually benefiting from the GST reforms. Are these 2 sectors that you're seeing as possible winners in the next couple of months that might be one of the underpinnings of a possible equity rally?
India is a very large market now. It's a $4 trillion market cap. Every sector is more than $400 billion of market cap. You can't ignore any sector. What we do is we look for market share gainers which have embraced technology, innovative distribution models, longer term skin in the game of the credible management. And that could be in financials, that could be in consumer discretionary, that could be in various other sectors.
So it's not sector specific in terms of what's embracing technology, what's seeing transformation. Are you saying that you really have to dig into these sectors because they're scattered across them?
Yes. Look at old economy. I mean, there are cost curves which are going down in maybe aviation, maybe in materials. So the framework applies to the whole universe of 5,000 stocks. Then it picks 100 stocks on which we do our portfolio management. It is not that we will miss XYZ opportunity. We will be evaluating all the sectors which fits our framework of this market share gainers and credible management and things like those.
Okay, and I want to take a step back in a bit, but since we're on sectors right now, one of the sectors that really caught everyone's eye this week was IT services because of the H-1B visa applications. Saw a bit of a knee-jerk reaction sell-off on Monday, actually hitting them. What is your view on the IT services sector right now, and will the H-1B visas actually be a long-term cause for concern, or is that just proving that this was just a knee-jerk reaction that we saw over the last couple of days?
While H-1B has certainly made a headline, I want to give you some context.
Sure.
Over the last 10 years, Indian IT services have re-engineered their business model. The data is like this. 6% of hiring was Americans, the local onshore hiring, till 10 years ago. This number has gone to 18%. They've increased it by 12%. And this path to 12%, they've created connections with the local governments, universities, they've ramped up hiring. You assume zero H-1B. What they have to take it forward is to 23%. So only 5% more they have to travel. They've already traveled from 6% to 18% into the local hiring. They have to go to 23%. And the 23% impact is 3% on EPS. So the business model will not break. It is a small dent to earnings. Why this is underappreciated is people miss 70% of businesses already offshore. And offshore is increasing. Every global Fortune 2000 is setting up a global capability center in India. So IT impact of H-1B.
So there's no need to bring them over anymore because the centers in India can provide that opportunity
and
for them.
Offshoring can increase further. After COVID, all of us have become more used to working hybrid, to accepting work remote basis. So that is the new reality post-COVID. So this headline, I respect that, but the impact on IT services is 3% of profit. And I also want to highlight 9 of 10 companies which have used H-1B last year were American. 2 in 10 were American.
Is this going to hurt
2
the
years.
American companies more than
That's
the
not the
Indians?
point because they're so big. I mean,
Okay.
all those companies, they can easily absorb hit. The point is it is not as big an issue as it has been made out to be, at least in our assessment. 3% earnings will not break a business model.
So just got to shake off the turbulence there. Anna, before we go, because we only have a little bit of time here, I want to get your thoughts on valuations, because this is one of the things that people have said that might have been hamstringing Indian equities. It's just that the things are too pricey. But you think that some metrics actually show that there are some opportunities and that valuations might not be as stretched or as high as some think so. Can you help us understand where you stand on whether or not Indian stocks are pricey or not?
2 data points. One, on PEG, in my memory, after a long time, I'm seeing India PEG closer to Asia, ex-India, and to China. Hasn't happened in last 10 years that PEG of India is closer to China and other Asian markets. That's one. 2, if you just draw a price to book chart relative to MSCI ACWI, All Cap World Index, India's 2 standard deviation low now. You don't get a quality market, less leverage, less dependent on external demand at a valuation which is below mean. In India, generally you get everything other than the valuation. And when you get valuation, there are some short-term concerns, and long-term investors, they look through those concerns. And we are seeing a lot of interest where investors are engaging with us and trying to understand, is this an opportunity to embrace a longer term? So valuations today are 2 standard deviation low on MSCI ACWI on a 15-year history. It can't get more attractive than that.
All right, so Anand, quickly, as you're trying to shape or perhaps tweak the investments or the portfolios that you're managing right now, what's the bigger guidepost for you? Is it earnings recovery or is it going to be valuations?
We are long-term investors.
Yeah.
We just embrace managements which are operating in sectors with tailwinds and who are working in a sustainable way. Those managements will win the game over 3, 5, 10 years. We don't worry so much about the near-term factors. But yes, in near-term, earnings revision ratio, we think is the most important when we backtest data. for Indian frameworks.
All right. So in the short term, earnings momentum, and in the long term, it's going to be some of these long term trends and who can actually withstand and make sure that the boat is steady. Anand Gupta from Allianz Global Investors, thank you so much for joining us today and helping us understand your thesis and your outlook for the Indian markets amidst all of these changes. Again, thank you so much for your thoughts, sir. Well, coming up, China's Guangdong province and Hong Kong are battening down the hatches as the biggest storm of the year bears down. We'll bring you the latest on that when we come back in about 2 minutes. Don't go away. Welcome back. Well, Hong Kong is in the midst of one of its most extreme weather events in quite a while. Emily Tan is taking shelter at home and assessing the ongoing typhoon that's hit Hong Kong. And Emily, this is one of the worst typhoons that Hong Kong has actually seen, or most intense typhoons that you've seen in a while. How are things going?
Well, the worst of it is over already, and I will say that it is T10. It is expected to remain so for a number of hours still, but the worst of the storm, the eye of the storm, has already moved past Hong Kong, and it'll be making landfall on the mainland in Guangdong province. So we are tracking the developments here. It was quite a night last night. I was woken up at 2 in the morning with the rain and the wind pounding my window. I was a little bit worried whether or not that window would hold, but this is the worst storm, the strongest storm this year in the world for 2025. Super typhoon Ragasa, making its way, of course, past Hong Kong, through Macau, and then onto the mainland. The Hong Kong Observatory says that the worst of it is over, but T10 will remain for some time. Now, the impact to the city here, we've seen, of course, cancellations at the Hong Kong airport since 6 p.m. last night, all the way through till 6 a.m. tomorrow. So till Thursday morning, Hong Kong time, before the flights can resume and people can get back in the air and on their way. So we are tracking the developments there. And of course, any of the congestion, the flooding, the fallen trees. I saw some video of the Fullerton Hotel over at Waterworld Park, that is part of Ocean Park, and the bursting of the glass doors. Quite dramatic footage, and we're seeing local media here doing live reports on that. The stock market is up and running as normal, and interesting and curiously enough, 1 year to the day yesterday that the severe trading arrangements have been in effect. So Hong Kong stock market is up and running, but there has been some impact to the IPO activity. Bringing you up to speed on Chery Automobile, which is going to be listing in the Hong Kong market tomorrow. The listing ceremony, the gong ceremony, is not going ahead, but the shares will begin trade as scheduled, 9 o'clock pre-market, 9:30 as usual. Zijin Gold, this is a spin-off of Zijin Mining in its book building to raise $3.2 billion in Hong Kong's second largest IPO this year. That'll be after Contemporary Amprex that listed in May. They have to delay their IPO because of the book building. They're pushing back subscription periods by 1 day as a result of the typhoon, and that delaying the trading debut by 1 day as well. So now the debut will be set for September the 30th. Really, business is, people are staying at home, sheltering at home, schools are shut, but the stock market is still running and a little bit of impact there. So hopefully we can get back to normal soon, but it is still T10 for the time being. Back to you now.
Yeah, and understandable delays there, Emily, because it's better to be safe than sorry, especially in the midst of a super typhoon. Emily Tan, thank you for the latest update, and do stay safe and stay dry. Most of Hong Kong's schools and businesses may be shut, but markets there are still open. And I want to show you the outperformer on the Hang Seng Index today. That's Alibaba, which is now surged by the whale. Take a look at that, 6.7% in the green, 170 Hong Kong dollars per share right now. And Alibaba Cloud has just released its latest and largest ever large language model, or LLM, as it ramps up its artificial intelligence push. Alibaba shares have now more than doubled year to date, and it's now at its highest levels in about 4 years. Meanwhile, a bipartisan group of U.S. lawmakers is making a rare visit to China this week. Elaine Yu joins us with the highlights of that trip. She joins us from Hong Kong, and I hope you're also staying safe and dry right now, Elaine. But walk us through some of the highlights and what are the key takeaways from this very important visit.
Yes, JP. So this is a hugely significant visit. It's the first House delegation visit from the U.S. to China since 2019, and it's led by Representative Adam Smith, which is the chair of the House Armed Services Committee. And so one primary focus of this visit is defense and military dialogue here, and he's called for improving military-to-military communications between China and the U.S. He said it is dangerous for us not to be in regular communications about our capabilities and intentions, especially given the close encounters recently between Chinese and U.S. Flights and vessels. Now, as for Beijing, Foreign Minister Wang Yi has called this an ice-breaking journey, and he said it's been full of twists and turns, this visit, and he said good things take time. But also back in the spotlight is Boeing, or at least the U.S. side is talking big on it. The U.S. ambassador to China, David Perdue, said that negotiations for a significant Boeing deal is nearing completion. They're entering the final stages. He didn't share any details about the size of this order or this deal, but he said it's a huge order and one that's very important to Boeing and both to President Trump. So this visit really signals the efforts or the desire to further prevent a deterioration in ties by both sides. And of course, significant challenges remain here, JP.
And perhaps signs of an initial thaw between the U.S. and China there. Elaine Yu, thanks so much. And again, stay safe and dry out there. We're taking a short break, but Inside India will be back in 2 minutes. Don't go in. The markets will be opening in about 18. Stay tuned. Welcome back to Inside India. 15 minutes before the midweek market open out in India, and we'll take a final futures check right now. Well, let's take a look at Asian markets first before we get to that. And remember, there is a slight significant wall of red right now after the comments from Fed Chair Jerome Powell citing that equity valuations may indeed be lofty. And we're seeing a lot of traders really trading on the back foot from Tokyo to Taipei today. The Hang Seng Index, one of the standouts because of a rally or intraday rally for the tech stocks out in Hong Kong. They're up by 0.9% as the city itself deals with the brunt of a super typhoon that is hitting that part of the world, including parts of southern China. And as we mentioned, we are counting down to that market open in India, that final futures check right now. We're seeing Nifty futures, once again, perhaps hinting at a possible slight gain. But keep in mind that the Mumbai benchmark itself is on 3 straight days of losses. And we'll see if they can shake things off and actually break out of that recent funk. We are seeing the rupee, though, also starting to firm itself a little bit, but keep in mind it did trade at its record weakest levels on record, or record lows, actually. Currently at 88.73. It is below that 88.83 level that it closed on Tuesday. And again, concerns about a softer local currency right now, perhaps just on the back of the mind of traders out in India. And we're continuing to track the fallout of America's hefty new H-1B visa fees. Indian citizens account for 70% of these allotted visas, which could put a limit on outsourcing. But this could also be an opportunity for a new outsourcing model. These are called Global Capability Centers, or GCCs, offshore arms of multinational companies. According to Indian Business Trade Association, NASSCOM, India hosts more than 1,800 GCCs and employs nearly 1.9 million people. Well, we have Vikram Ahuja, who's the co-founder and managing director of Answer, to perhaps provide the answer as to whether or not this is an opportunity or a risk for the IT services industry and this new business model that has emerged out in India. Vikram, thank you so much for joining us today. Let's talk first about the H-1B visas and the possible reshoring or return of these jobs to India. In a worst-case scenario or in a grave-case scenario, how much reshoring could happen should the H-1B visa restrictions actually take effect? What are people in India and what are GCCs expecting with regards to a possible reshoring trend should this indeed come to pass?
Sure. Thank you for having me. The new H-1B fee that's been added in some ways is a long pending reorganization of how labor and workforce is organized in the US. I think there's been talks about this for a while. But in many ways, many organizations are looking at this less of a tax and more of a signal towards where global workforces are headed. In some ways, if you look at what's happening around the world today, the conversation is about finding the best talent, wherever that talent might be. And many organizations have already taken significant steps to harness the power of global talent. So if you look at global capability centers today, as you mentioned, there's close to about 2,000 centers employing close to about 1.5 million professionals around the world. And the story today is about building strategic capabilities, building AI, building product, building cybersecurity frameworks, and in some ways doing work that is mission critical and core to the companies. So I think in many ways, this is going to be a significant moment in how global organizations think about doing work and who does that work.
Yeah. Vikram, let's take a step back. Can you help us understand the difference between these global capability centers? Because it seems that this is a fairly new business model, at least for India. How different is this from the traditional outsourcing outposts that India's really specialized in over the last couple of decades? And does this new business model perhaps insulate you a little bit more from a lot of the issues that have arisen over the last couple of days?
Absolutely. So global capability centers in its simplest forms is an office or an extended capability hub anywhere in the world, like any other office, but predominantly located in talent-rich areas. So think of it as a completely owned, integrated, fully strategic office that houses employees that are doing critical work for the organization. So these are employees, these are part of the company, these are folks who take ownership and accountability in building the company forward. And in many ways, it's the other side of outsourcing. It represents insourcing. And it's a way for organizations to build critical capabilities while also bringing in the level of expertise and experience that they need to move forward. Outsourcing, of course, as an industry has remained for many years. It's been close to about 3 or 4 decades and has done phenomenally well as in terms of providing service to large organizations. Global capability centers in some ways represents the new evolution of work, which is as more and more companies become technology enabled and the desire to own IP and ownership for the end output becomes more and more critical, it's important that organizations think about building teams that can be integrated into the setup and have critical levels of accountability, right? So that's really where the industry is headed. And it is fundamentally different than outsourcing. It's insourcing. It's, organizations investing in building their own assets and capabilities. And I think that difference is well understood between the industry players today.
All right, Vikram, let's talk again. Let's go back to the issue of the H-1B visas and the possible return or re-influx of talent from overseas. How capable are the industries in India, whether it be IT services or GCCs, at absorbing this returning talent if it did come back? And I ask that also because there have been concerns about rising youth unemployment in India, and thus could put even more pressures on a job market by increasing competition or job seekers who come back. What are your thoughts on how easy or difficult it's going to be to absorb any potential returnees based on these H-1B visa restrictions?
Yeah, absolutely. So, the growth in global capability centers has been constant over the last many years. It's been growing at about 15 to 20%. Even before the recent news about H-1Bs, we'd been seeing at least between 120 to 150,000 jobs that were being created annually. And that number continues to grow. So in some ways, this could be a huge opportunity for India to position itself as the capital for GCCs. But also, if you think about the kind of work that's coming into these global capability centers, there's an increasing demand for talent that needs to be upskilled and reskilled. If you look at what's happening with AI and everything related to AI, for example, today there's a shortage of talent around the world. So we think that there's a tremendous opportunity for the industry to absorb any sort of impact from the H-1B news, but also create net new opportunities for talent in India to stand up and really take advantage of what the world is asking for.
Vikram, I want to get your thoughts also on a possible headwind here, and that's the HIRE Act that's being proposed out in the U.S. And apparently it's not just going to target possible outsourcing. It could mean a 25% tax also on, say, companies that invest overseas or hire overseas, such as at these global capability centers. Is this the bigger concern that we're going to have to watch out for as GCCs evolve and develop out in India?
Sure. So, first and foremost, I think with global capability centers, this is not a cost play. This is a capability play. It's an opportunity for companies to really sort of rethink how work gets done and harness the best talent wherever that talent might be. So in some degrees, it's not about cost parity here. It's about actually ensuring that, you have availability of critical talent. So while the HIRE Act in its current form does look to tax work that is being done overseas, we believe that the global capability center industry, is here to stay. I mean, there's the number of employees that are hired today by firms working for developing these critical capabilities is immense, and that's not going away. And we feel that the industry now has a story beyond just cost and labor arbitrage, and in some ways it's about talent arbitrage, as we call it, right? So I think the opportunity really is to present an even more strategic positioning for the industry and make it, an almost critical imperative as companies think about what the next 5-10 years holds for them.
All right, Vikram, let's help us perhaps understand what the cost advantages are, if there are any, between perhaps hiring out of a GCC or keeping those employees at your U.S. operations via an H-1B. Talk to us about what the possible cost differentials are between these two particular models.
Yeah, absolutely. So as with different labor markets, you've got different volumes and availability of talent, as well as different standards of costs that apply for these labor markets. So if you look around the world today, you've got multiple markets that allow organizations to create these hubs. In addition to India, you've got countries like Mexico, Vietnam, you've got Canada, as well as countries today that are emerging out of Eastern Europe. Poland, of course, is a big hotspot. And all of these markets offer different varying availability of skill pools, as well as the experience of the talent pool itself, right? So from a cost perspective, if you were to just look at salaries, for example, at the senior levels, we're seeing that, talent is being paid what it's worth. And in many ways, you have employees that are being hired that come close to getting US salaries even in a market like India. But again, the conversation here is not about cost. It's about how do you access the best talent for doing the best work. Talent, of course, at junior levels or at sort of, midterm levels tend to have differences in how they're paid, and that's purely a reflection of the differences in cost between different countries. And so this could be anywhere between 20 to 50%. But again, as organizations build these centers, cost quickly goes out of the conversation as the focus comes back to volume, quality, as well as retention of talent.
Which is why the first C is capability and not cost, I guess. Vikram, before we end, I wanted to ask you your thoughts on something that a guest we spoke to earlier this week mentioned. He said the H-1B visas aren't the biggest problem for India, actually. It's a short-term hiccup, perhaps. But really that the very business model of outsourcing and BPOs itself is under threat from technologies like AI that could disrupt it significantly. Do you agree with that sentiment? And how would a GCC, for instance, the way it functions, perhaps offset any of these possible risks to the old business models?
Yeah, absolutely. I think with AI and the evolution of the technology in its current form today, we think that it represents a huge shift in how organizations think about work. There is an opportunity today to build very interesting hybrid work models, which combines human intelligence along with autonomous digital agents that can do a lot of the recurring manual work that humans used to do. And that's going to fundamentally rethink how we think about staffing capacity for work. So in some ways, IT services were built on the backbone of providing, human-led expertise and of course, volume of talent to do work. And that gets challenged in a model like this, where you can have digital agents that can do the same work that humans did with human intervention, but of course, do it at scale and almost do it 24/7, right? So there is a significant change that I think IT services companies will bring about in terms of the value they provide. Now, for GCCs, it's a different conversation because in many ways, GCCs are the enterprise. And so the way we think about work and who does the work changes as well. But again, the autonomy and control remains with the organization. So as we see newer companies being set up, early questions that are being asked is, who does the work? Should it be my employees? Should it be my outsourcing partners, or should it be an agent? And I think these are the questions today that are going to lead to the sort of hybrid workforce that's going to become almost the truth of tomorrow, right? So we're already seeing that in action, and in many ways, this is being led by the Global Capability Center.
Just very quickly, Vikram, there's concerns about this HIRE Act, which hasn't been passed yet, but is being deliberated to perhaps impact some of these investments, actually. There's more than 1,800 GCCs. Where do you see the number of GCCs growing to by the end of, say, next year?
Yeah, absolutely. I mean, if you look at the Fortune 500, less than 30% of them have GCCs. So there's a huge headroom to grow. So we're very optimistic and ambitious about the industry as it is today. We anticipate that there will be at least a 60% increase in the number in the next 2 to 3 years. And we're adding, anywhere between 70 to 100 new GCCs every year. So it's exciting times. And we feel that the changes in global labor markets is only going to add more momentum to the industry.
All right, 60% growth in the next 2 to 3 years, and hopefully 60% more much-needed jobs for India as well, if it does come to pass and everything goes to plan. Vikram Ahuja from Answer, thank you so much for joining us today and helping us understand the new GCC model and how it might withstand some of the new pressures and uncertainties we've seen transpire over the last couple of days. Well, shifting focus to the Middle East, Dan Murphy is joining us from Dubai. Dan, tell us what you are covering on Access Middle East today and more Chinese tech firms perhaps expanding into the region. Is that going to be something that's going to be front and center for you later on in about 16 minutes, sir?
Indeed. Good morning to you, JP. Well, later on the program, we are going to be speaking with James Peng at Pony AI. Now, of course, this business needs no introduction. Very well funded, listed on the NASDAQ, at least for now. And it's announcing a major expansion into Qatar, of course, one of the key Gulf markets. So on Access Middle East, in just a short while, we'll speak to him about the strategy behind this new expansion, but also the timeline to commercialization. The great promise, of course, of these robo-taxis is that they are going to change our lives and ultimately make investors a lot of money as well. But what we want to know is when the rubber is actually going to meet the road here. So far, we've heard a lot about what's happening in the testing space and where Pony AI is attempting to get regulatory approval. We don't have concrete timelines on that yet. And at the same time, the business has also said it's going to be profitable. We want to know when. Of course, we'll also be asking about what other markets it's going to be expanding to as well. And of course, what's happening with NVIDIA chips. Of course, Pony AI also relying on that critical US technology in the face of what is a widening, growing, expanding trade and tariff tension between the US and China, meaning that quite possibly these Chinese businesses may no longer have access to those chips. So we're going to be asking about that as well, JP.
Yeah, and Dan, I think there's also hints perhaps at the Gulf region itself, perhaps carving its own space or its own niche in this fast developing AI and tech sector. I mean, what else perhaps are you hoping to find out with regards to that particular theme, and whether or not Chinese tech firms have a part to play in helping the Gulf region carve out this niche in a more definitive manner?
Well, this is a really interesting space because in the last few years, what we've seen is the investment corridor between Asia, in particular mainland China, and the GCC really growing. This is worth multiple billions of dollars, in some cases even trillion-dollar investments that are taking place here. And that's really important because it signifies that the Gulf region is attempting to act as a bridge between its key investments in the United States and also with China as well. So really acting as somewhat of a balance between that geopolitical tension and that geopolitical rivalry. At the same time as well, we've seen major Chinese companies like BYD also announcing their expansion into key markets in the GCC, like the UAE, for example. If you remember yesterday on Access Middle East, we also spoke with Stella Lee at BYD, getting an insight into why she believes that the UAE is going to be a key growth market for that major Chinese automaker, and why she thinks that EVs are ready to hit the market and scale in what is traditionally, you could say quite a skeptical market when it comes to these Chinese electric vehicles. This is a market where, we see lots of G-Wagons on the road, lots of Toyotas on the road, lots of big SUVs. She's pretty confident that they're going to be able to make their mark in this market, and not just here, but in Saudi Arabia as well, doing it all with their own technology, their own vertical structure, and perhaps with less reliance on American tech as well. So a lot happening in this space, JP. We're going to unpack it all at the top of the hour.
Yeah, and a lot of these details also coming at a very timely portion, Dan, because of how tech stocks in Hong Kong have rallied so far this Wednesday. We'll be looking forward to that. That's Dan Murphy. And remember, these conversations and updates happening on Access Middle East in about 12 minutes. Well, markets in Mumbai have just come online as well in the last 3 minutes, and we'll bring you the early movers when we come back in about 2 minutes. Don't go away. You're still watching Inside India. Indian markets have come online in the last 5 minutes. We're seeing signs of the Nifty 50 perhaps on its fourth straight day of losses, and perhaps one of its deeper intraday pullback today. They're down by about a third of a percent so far today's session. 25,086 is where the benchmark sits. Meanwhile, we're seeing the rupee trying to find its footing right now after hitting its weakest levels on record the other day. 88.74 is where the local currency sits against that U.S. dollar. Let's look at some of the movers in the Indian markets today. And we've got the latest sales numbers yesterday from Maruti Suzuki and Hyundai Motor India. It shows a strong start to bookings this quarter, with part of that coming from those GST reforms that came online just last Monday. This has also brought down the prices of commercial and passenger vehicles. Now, it's also festival season, with a 9-day Navratri starting this week and Diwali in just a month. Auto stocks are now trading a bit mixed, though, today after the recent rally, with only Maruti Suzuki keeping its head above water. Meanwhile, the likes of Tata Motors and Hero Motors and Mahindra all flashing red so far this Wednesday morning. Well, staying on cars, JSW Group is set to launch cars and trucks under its own brand. JSW Motor is a new offshoot separate from its joint venture with MG Motor India. CEO Ranjan Nayak says its first vehicle is expected to hit the market in Q2 or the second quarter of next year. The aim is to introduce at least one new model every quarter. The first car will be an electric car or a plug-in hybrid. We're seeing JSW shares up by about 0.4%. And we're also watching shares of Swiggy. The Indian food and grocery platform is selling its entire 12% stake in Indian ride-hailing platform Rapido. Dutch investment firm Prosus will buy a majority of the $270 million stake, and U.S.-based Westbridge will purchase the rest. Swiggy said that the move was prompted by a potential conflict of interest as Rapido ventures into food delivery. Well, turning our attention now to Japan, Apple CEO Tim Cook is in the country in his first visit there in nearly 3 years. Lin joins us to tell us about why the Apple head honcho is in Tokyo right now. What gives and what brings him to that part of the world, Lin?
Yeah, indeed. He is in Tokyo at the moment. He will be there for most of this week. And really, the focus is to welcome as well as promote the upgrade of the Tokyo Ginza store, which does hold extra, value for the company, given that it was the first retail store that was opened outside of Apple's domestic US market. So 20 years on now, the first major makeover. And as you can see in that video, that is the 4-story store behind Tim Cook, who is posing there with one of the popular Japanese boy bands as well. He said in the official Apple statement that this is a milestone and it's a symbol of the strong ties that the Cupertino giant has both with customers and communities in Japan. Although it is worth noting that in recent years, we've seen both Japan's significance as a consumer market as well as a procurement and supplier market for Apple somewhat, or at least slowly waning as well, as certainly countries like India, Vietnam, as well as South Korea have gained. One of the things that Apple will be watching closely as well is that Japan is set to introduce its new laws in relation to changes to the software systems there. This was a law that has been talked about for some time now. It was enacted last year, but it will be implemented at the end of the year. It's similar to the EU's Digital Markets Act, and basically what it means is that it's going to force the likes of Apple as well as Google to open up its operating systems to allow third-party app stores. So presumably this is going to give users more choice and make it potentially cheaper as well for developers. But Apple has pushed back. It is certainly working with the regulator there, but has expressed in the past concerns around security. So this could be something that is on the agenda for Tim Cook as well. JP.
So just to be clear, Lynn, he's not forming a boy band in Japan?
Not from what we're aware, no.
All right, important note there, the tidbit there as well. Lyndon, thank you so much for bringing us to why Tim Cook is in that country right now. One more look at Asian markets, and again, many are taking a backseat and perhaps trading cautiously after Fed Chair Jerome Powell warned that equity valuations may indeed be lofty. We're seeing intraday losses in Tokyo and out in the Kospi in Seoul. Meanwhile, the Hang Seng we mentioned still rather defiant and looks like it's pulled the Shanghai Composite up with it as well. Tech shares helping the Hang Seng rally here on the back of Alibaba launching that large LLM model that's really boosted tech stocks out in Hong Kong. We'll take a look at Forex markets as well. A quick flip of the board there, and you'll see here that many are actually succumbing to that almighty dollar, with the exception of the Indian rupee, which, as we mentioned, has firmed itself up a little bit so far in one of the standout currencies. But keep in mind, it is just 1 day shy of hitting its weakest levels on record, currently at 88.70 against the US dollar. Well, that's all the time we have today on Inside India, but do keep watching CNBC because Access Middle East is up next. Have a good morning.